A sigh of relief for Silicon Valley Bank customers who now stand to recoup even uninsured deposits. And that's thanks to a narrow banking law exception tapped by the Biden administration. Yahoo Finance legal correspondent Alexis Keenan is here to explain. Hey, Alexis, I know a lot of people have questions here.
Yeah, Rochelle. So plenty, too, of really financially sophisticated folks who don't like the fact that the Biden administration has tapped this very narrow legal exception that allows the FDIC to reimburse both cash and cash equivalent deposits at failing banks in excess of $250,000. One of them being Citadel founder Ken Griffin, who said to the Financial Times reportedly that the government's reimbursement of these uninsured deposits amounted to evidence that there's a breakdown in American capitalism. So let's talk about the legal framework that actually makes all of this possible, makes the government able to give more than $250,000, so uninsured deposits at these failed banks. It comes from a 1991 law, and it's called the Federal Deposit Insurance Corporation Improvement Act. And it was adopted in response to failures at both commercial banks as well as in the savings and loan industry in the 1980s. And the law actually decreases the FDIC's power by directing the agency to resolve bank failures at what they say is, quote, the least cost to taxpayers. And even if that means that the losses to the depositors, losses to uninsured depositors, creditors, as well as shareholders, even if they lose money, they're supposed to, by law, go ahead and make those limitations. But this very narrow exception, it comes into play when the U.S. Treasury Secretary decides that this least cost method of limiting, let's say, $250,000 to reimbursements of these depositors at failed banks, that when the Treasury Secretary says that it would cause systematic risk by adopting that method and that more reimbursement from the government would actually lessen, quote, serious adverse effects to economic conditions or to financial stability. So critics, though, of course, calling this move a bailout. Legal experts tell me that that's kind of a gray area. While bailout isn't a legal term, they say on one hand, the Biden administration is saying that taxpayers are not going to bear the cost of this move, that the assessments to the banks to refund the FDIC and its deposit fund, that's the money that will be used to pay out these losses. But on the other hand, they say that, look, the losses, the banks, you can better be sure that they're going to pass them eventually along to their customers who are these depositors at the bank. So kind of full circle there. Rochelle?
And we know, like, the word bailout can be quite triggering. People have compared it to, student loan debt and bailing out perhaps companies who didn't make it through the pandemic. Then what is the legal perspective on the critics who are actually calling this a bailout?
Yeah, so that's a little bit what I was just talking about there, is that they say, yes, the Biden administration has come out and said this is not a bailout because the funds will not be borne to recoup the federal insurance fund that pays out these losses, that the taxpayers won't have to do that. But the thinking is that at the end of the day, if the banks have to be assessed more money in their quarterly assessments that fund the FDIC's fund that actually pays these out, then that's just going to be a pass-along cost to customers. And at the end of the day, that customers will bear the cost here. So a lot of gray area, a lot of interpretation to be made. But this is what legal experts are at least telling me about this exception to the banking law.